three ladies in my journeys along the way. And of course, because we're crazy and like to do things at odd times, we created a development company right in the middle of COVID, an all-female development company at that. So I'm so excited to be a part of this group. I currently still have a full-time job and I work for the City of Vancouver. I manage a portfolio of over 200 assets, anything from day-to-day maintenance and capital renovations and improvements, and all the budgets that are associated with them, and 3 large operational teams. So that is what I do in my day job, but I'm just so thrilled to be able to live my dreams in my side hustle, which hopefully one day will not be my side hustle anymore and will be my absolute dream of living full-time as a real estate investor. So that's a little bit about me, and I'll tell you a little bit about us. Crown Capital Properties, as I said, we formed the company last year to be, as we know now, the only all-female real estate development company. So we're quite proud of that, and we're quite proud of hoping to lead the way to encourage other women to get into the business and into the development community. Our sole goal is to look for opportunities to build better communities where we're working. We're focused right now on purpose-built rentals because we know that there's a desperate housing need, and we are currently focused in the city of Esquimalt because we've identified that as a really wonderful place to do business, and the community, the city are very supportive of creating new buildings and just fulfilling the housing needs that the community has because they're desperate for it. And with it being the closest community to Victoria and downtown Victoria, we see that there's just a lot of opportunity there over the next little while. So we are focused in that area. And, one of our other goals outside of kind of meeting the housing needs of the community that we're focused in is also supporting our investors' long-term goals. Many of our investors, I can say actually all of the ones that I've spoken to have told us how excited they are to stay on this journey with us for the long term and to really build wealth through a partnership with us. And so that's super exciting. So we're so thrilled that the investors that have come on board really see this as an opportunity for them to have a long-term partnership with us, and that is really fulfilling and rewarding for us because it speaks to Liza's collaborative communities and achieving those goals. And this type of an investment is a passive opportunity for our investors. They can sit back and be a part of it, but they don't necessarily have to do all the hard work. So for those of our investors who want to learn about the process, it's a great opportunity for them. For those who just want to put their money somewhere that they feel comfortable and safe and be involved in a really exciting project, then it's perfect for them as well. So that's kind of our 3 top main objectives for the development of Crown Capital Properties. And so far, we're really excited that we're meeting all of our goals. For those of you who have been on the calls before, these are our projects. So the one that Liza referenced, we bought a 4-plex, and we are building a 22-unit, 6-story purpose-built rental. This is our Constant Street project. That's our current one. We've got the project in here from Agnes Street. That's a project that Lori and her husband actually worked on, I guess, within the last few years. They actually duplexed a single family home. So they learned a lot through that process and were successful in that project. And Robert's Landing is just one of the examples of the buildings that Sherry and Rick have already built together. I think you're up to 6 now.
And we've completed 3 and have another 3 on the go.
Perfect.
Yeah.
And Robert's Landing is just an example of that. I mean, we would love to share them all. And maybe in the next, we'll be able to show some of the under construction projects. They're pretty exciting. Oops, sorry, going backwards. And with that, I'm going to hand it over to Lori for her introduction and to share some exciting news that she's got, and exciting news that she just had confirmed before we got on this call tonight.
Hi, everybody. Thanks for joining us. Nice to see some new faces there. My name's Lori Finnegan. I'm a partner with Crown Capital. Also extremely grateful to be part of this amazing team of very smart and savvy ladies. I'm learning lots. It's certainly exciting to get into the development realm right now. So there's lots to learn, and we're very grateful to be sort of in this business at the time it is right now in Victoria. I've been looking at a Esquimalt for a while now. I live 5 minutes from Esquimalt in Vic West, and I've been looking to buy something in Esquimalt for the last couple of years. I was fortunate that my partner and realtor, Sherry Krause, brought an opportunity to me before Christmas back in November. It was sort of an off-the-market property that she showed to myself and my husband. And this one was going to be more of a fix and flip, because that's what I want to get into this year. We have a portfolio of buy and hold properties, and we thought that we'd try to venture into the fixer-uppers this year. And so we looked at this property. We were sort of hesitant at first, because we thought, no, I mean, what's the market going to do in the next couple of months here, the next 6 months? It can't keep going up. Anyways, we got over the nerves and we bought it, and we've been renovating it the last 3 months. These are some before pictures here. We finished the renos about 2.5 weeks ago and listed the property. And if you want to go to the next slide, Joan, I'll show you some of the after pictures. We had the property staged, and we had viewings just over a week ago. And we did get an accepted offer, and the conditions were removed about an hour ago. So we're extremely excited. This particular project, we actually partnered with our builder. So we thought this would be a great way for us to, to get into this sort of a business and have a team at hand that we can partner with. So we did some profit sharing with our builder, and it sort of incentivized him to keep on time and on budget. So we did quite well on this property, and we are now looking for the next buy and hold, the fix and flip. We did have one fix and flip that we ventured in with Liza and a few other partners a couple years back, but I think it was more of a fix and flop. So that one didn't work out. So we're very grateful that this one did, and excited to look for the next one. So thanks for joining us tonight, and I'll let Sherry, I believe, take over.
Okay, so I'm Sherry, and I'm very happy to announce that we were doing fundraising for our project on Constance, and we are now fully subscribed. So for the 2 million raise that we were looking to do, and so we're very excited that that came together really quickly, and very, very happy about that. So just to tell you a little bit about myself, I am a realtor, is my day job, and I've been doing that since 2007. But before that, I was a real estate investor as well as a financial planner. So that's sort of my background, and I got into investing and wanted to get out of financial planning. So decided, oh, let's do real estate and become a realtor and learn that side of it. And I love it, actually. So I'll keep doing that. My husband is now just retired, so he let his real estate license go, and spends time helping me with some marketing and plugging away on some of the development stuff. But yeah, he's enjoying a lot of time at the moment, so that's good. So just really happy to be involved in this project and have Joan and Liza and Lori on my side here, which is good. And we seem to be working well together. and teaching each other a lot of different things. So anyway, I won't take up much more time because we have more exciting things to talk about into the tax realm.
We do have exciting things to talk about. And so just before I introduce Dave and Jivanne, just a couple things I want to highlight. So first of all, Sherry has written a chapter for the book that we are releasing. So some of you may have seen it. It's going to be titled From Ordinary to Extraordinary. And we have a number of women from across Canada who are going to be sharing how they have succeeded in real estate. And I tell you, the stories that women are sharing are really raw and really vulnerable and really, really inspiring. So it's going to be pretty exciting. We'll post a first little introduction to that probably tomorrow or the next day. And I know that we're going to turn the screen sharing over to Dave in a moment as well. But just before we do that, you can have a look at this slide. This tells you a little bit about Dave and Jivanne. And so Dave and I met at the Victoria Real Estate Investment Expo, which was, gosh, 2017 was when we did the first one. Dave came out, I can't remember if Dave came out for both of them or if he was there for the second one. It's all a big blur now, but Dave's been involved with all kinds of people over on the West Coast. He's based in Markham, Ontario, so he deals with all clients from all across Canada. And we've just kept in touch, and he's always been there to answer our questions. Some of you may recognize Dave from helping Joan and I when we were starting to work through the whole mobile home park piece. So Dave does taxation across the border as well. And so he was helping us with the mobile home park stuff. And we just had a really interesting thing that we're going to be talking about, I'm sure. My burning question now about writing off our mobile homes for tax purposes. So I'll be asking that question. And I also, want to welcome Jivanne. We're meeting Jivanne for the first time tonight. She's been with Dave for a number of years. I'm sure Dave's going to tell us more about Jivanne. And he decided, it'd be really great to get a woman on the team because there's so many of us. And I know, guys, there's a few of you in there too. And we had a few of the gentlemen reach out this week and say, hey, I really want to join this talk. Is it okay? And absolutely. The guys are always welcome. We always just like to let everybody know that, yes, we are a women's development group, and yes, WREN, which is often involved in some of these meetings, is the Women's Real Estate Network. But that's just because we're trying to encourage women to participate, but the guys are always welcome as well. So let's let Dave share his screen. He's going to share some details with us.
I'm just going to interrupt for a minute. Susan's having trouble. She's saying she's not able to see any of the shared screens.
Okay.
And does anybody have a quick tip? I was just wanting to make sure she was allowing it, but I don't know if there's a quick fix for that.
Let's just see. Susan, are you able to see it yet? If you're on an iPhone, you sometimes just have to swipe it over to the next screen, or you just have to reduce or expand your screen on your device, depending on what you're on.
Yeah, no, I am on a laptop,
and
I don't normally, I've never had to change any settings. It's usually on the presenter side where the screen sharing issues have been in my past experience anyway.
Okay. I think everybody else can see it. Can you see it now?
Yes, I can.
Okay. Perfect. Good. Excellent.
Beautiful.
Okay, so we've got Dave's screen up, and Dave and Jivanne, we'll all mute ourselves. So we can, if you like, just go ahead and mute. We can, that way we won't, Dave won't hear any of us tapping or talking in the background. But if you have a question, just type it in the chat, or we'll unmute. But we'll let Dave get started. So Dave, take it away. Thanks for being here. It's 10 o'clock in Ontario, so we appreciate you staying up late.
Oh, my pleasure. I'm glad to be here. I always like getting on these types of meetings with you guys because the energy is worth me staying up past my bedtime for. It carries me through the rest of the week. So thank you so much, all you, for all you do and for keeping me on my toes with things like this. So Jivanne's on the call and as well, and Jivanne is a key member of my team at RealFile and our team. Alan's my partner at RealFile, and some of you may know Alan. But we started RealFile 6 years ago because there is a need for support and advisory for people who at that time were grassroots and getting started in real estate. Unless you go to KPMG and pay $900 an hour, there really isn't access for the frontline investor who's trying to get started. And that was a void that we filled. And here we are 6 years later, and we've got clients with $250 million in assets and still people looking for their first investment, passive investment, and LP, what have you, but all along that spectrum now. And it's been wonderful to see. And so what I'm going to basically talk about here, and I'll go through this with a little bit of expedience. And then, you know, I'll invite questions and Jivanne can answer some of them. Jivanne has been a CPA for, I don't want to tell tales out of school here, but Jivanne, but I'm thinking 25 years. She was formerly with BDO, which many of you know as a mid-sized firm in Canada. And our talent at RealFile is, you know, we have Belle from KPMG, obviously my partner Alan from Deloitte, Jivanne from BDO. We've got 7 CPAs on staff. So, you know, without having to pay the KPMG fees, you can really get some expertise for, you know, and Liza had asked if I'd been stumped recently. I get stumped all the time, but it's nice to have people like Jivanne to bounce things off. So let's see a whole lot of questions after I go through this, and I'll go with some expedients. So something might pop up, write it down, and then we'll get to it at the end here. So what we're seeing now is, this is Tim Sesnick, a giant in our field. This is as of 2018, it's getting even worse, but as people partaking in real estate, if you're an investor, possibly you're doing flips, possibly you're a passive investor, possibly you start your own corporation, whatever it might be, CRA is really cracking down on real estate. And HST or GST is a big component of it. They've just hired all kinds of new auditors specifically for real estate. Maybe you just sold your principal residence and you're getting questioned about it, but we're seeing more and more things occur. And what this article is talking about is the fact that the auditors are working off a very narrow script nowadays. When I was there, there was so much flexibility allowed for the auditor to be able to make decisions, to be able to use professional judgment and allow a deduction or disallow it, or close a file without needing to make any changes. And that really is being lost now. And it's a real big problem, because people who would otherwise not have done anything wrong, or who haven't done anything wrong, and who would otherwise have simply been a open and closed shut case, are now having to jump through considerable hoops to be allowed the deductions they're entitled to, or the tax treatment they're entitled to. And in some cases, this means tens of thousands of dollars of accounting and legal fees to be able to get what you should have been able to get all along. And this is really where we're coming in, is to make sure our clients are prepared for the changing culture at CRA. So one of the other things that we're worried about are the tax increases that are coming. It is fairly well documented now that capital gains taxes, there seems to be a consensus that capital gains taxes are going to be going up. The NDP has made no bones about it, that they think the capital gains tax needs to go up to 75%. Okay, but here's all the articles we're seeing, not just Mickey Mouse organizations. We've got MNP and Advisors Edge and banks, etc., saying there's a capital gains tax on the horizon. The interesting thing about the NDP saying they want it to be 75% is that they kind of hold the balance of power right now in Parliament. So you could conceive of a situation maybe growing less and less likely now that we might be looking at an election coming up. But if there is a minority and they hold the balance of power, and the Liberals want to get something done, that they give in and raise that capital gains to 75%. One of the, especially with this super hot market right now, right? So how do we plan for the increase in capital gains? What can we do? And I'll give you a secret. Owning things in your personal name is about the worst thing you can be doing. Investing in your personal name is usually a problem unless you have a really good plan. Things like fix and flips, things like buying a mobile home for business. These types of things need to be done in something other than your personal name to, one, lower your taxes now, but also protect against potential capital gains raises down the road. And there are certain strategies we can do when we have it in something like a corporation or perhaps a family trust or whatever the structure might be. But there are very few things open to us when we invest in our personal name and hold assets in our personal name. Okay, and this is part of that spectrum I talked about at the beginning, where we see what the people with $100 million in assets are doing, how they're successful, how they're protected so that their kids get the money, so that it stays in the family. Our wealthiest families in society keep money in the family generation to generation, and they don't do it by owning things in their personal name. So there's my spiel. Now, 2020, you may have filed your tax already, or maybe you haven't. Here's some quick bullet points. I'm just going to go through them because everybody wants to know what you can deduct. Well, digital news subscriptions, journalism, organization, political contributions, moving expenses, childcare expenses, medical, alimony, employment expenses, union, professional dues, carrying charges, interest expense, all these things. Your Prime membership, if you have a business or you're investing as a business, you know, these are the kinds of things you want to take to your accountant and get some deductions, right? These aren't $1 million, but part of keeping more in your pocket is getting everything you can and everything you're entitled to, all right? Home office is a big one. A lot of people had to work from home during COVID, right? And you're going to get $2 a day up to a maximum of $400. Again, not $1 million, but it's a $400 deduction. Now, this is different from people who previously worked from home as part of their job, okay? And that is a different deduction or a different form. That's called the T2200. And you can likely get a heck of a lot more than $400 when you were an employee who was already working out of the office. But if you were an employee who normally worked in the office and you had to work from home, then you will get that. Hopefully your employer will give you that T2200S and you get a $400 deduction, all right? If you got CERB in the year, there was no tax withheld. And so you're going to have tax to pay potentially at the end of the year. And that's something to keep in mind. Your accountant didn't do anything wrong. I don't know how often Jivanne and I get that. Yeah, but I didn't pay anything last year. And, you know, unfortunately, things changed since last year. You didn't have income last year. That's why you didn't pay anything. This year you have CERB, or your taxes were deducted at source last year. No taxes were deducted from your CERB payment. So there's also a clawback if you're getting the new recovery benefit. If you exceed $38,000 in income, you're going to have a clawback. Okay. Employment insurance, there's going to be a clawback at $67,000. These are some of the things, you know, this is an important one. And this is part of tax planning, and I'll show a slide in a moment here. But what we, as accountants, want to try to do is smooth income, right? Because you might run into a situation where you're over 65, you're getting old age security, and in 1 year, you have a big capital gain. And again, this is why a corporation could be useful. You have a big capital gain and your income exceeds $79,000. Well, now old age security will be clawed back. Whereas if you had earned that income in a corporation, you could have continued to earn your potentially old age security and just controlled the taps about how much you received from your corporation. So tax planning is important for situations like this. Okay. You know, paying a reasonable salary to family members if you own a business or a rental property is a good way to split income, to be able to lower your tax bracket or your taxes by getting into a lower tax bracket. All right. There is the requirement of reasonable remuneration for a reasonable contribution. That's the definition of when you can pay a salary to somebody. So what we say is, let's make sure we document your mother-in-law's contribution to your business, right? Let's have those emails back and forth to say, yes, I've arranged for appointments for you and I'm sending out your mail this week and I've looked after your bill payments, whatever it might be. But Jivanne's laughing because it's kind of tricky, right? But let's document these things. If we know, if we started out with CRA is cracking down, if we started out with the culture is changing, if we start out with it's less and less flexible, then let's make sure we give them what they need to see, okay? Because you'll go to some accountants who will say you can pay a reasonable salary, let's pay them a salary. Absolutely you can. But when it gets questioned, how do they uphold it? How do they make sure it doesn't get denied? Well, this is what we want to make sure when we're dealing with clients, we can have this backup, okay? So accelerated depreciation for capital asset purchases. Too late to buy something now from, you know, if you were late in the year and you were trying to use up some money and lower your taxes, this might have been a good opportunity to buy an asset late in the year, maybe a trailer, maybe a lawnmower, maybe whatever it might be that you need to get an accelerated depreciation, lower your taxes last year, something to think about for next year. And if you did buy something, know that you can get some accelerated depreciation on it. RSP is done. Zero emission vehicles. Everybody is excited about this, especially our real estate agents. Jerry, I don't know if you've bought one yet. I know, you know, Liza was putting up her hand. I don't know if you bought one. I know Joan bought one. And you guys, oh, you didn't. I've got a lot of real estate agents who are availing themselves of this opportunity. Generally individuals who are making a higher income in the year are looking for more deductions. And if you're going to buy a car, and real estate agents are turning over cars more quickly than the usual type of P4 earner, well, it's a good opportunity to get a $55,000 deduction all in 1 year. You contrast that with, and by the way, plus GST or HST. So you contrast that with the normal vehicle. If you buy a normal vehicle, okay, for your business, that vehicle is maxed out at $30,000 plus GST, which must be depreciated on a schedule according to CCA. Sorry, I assume I'm supposed to admit people now that I have the screen, so I'm doing that. Okay, so when you buy a normal vehicle that isn't a electric vehicle or zero emission, the maximum deduction you have is $30,000, but that has to be depreciated essentially 20% a year, declining balance. At a minimum, it's going to take you 5 years, which is a $6,000 deduction each year. Well, wouldn't it be great to get a $55,000 deduction all in this year, especially if you made a lot this year? Why do I need, you know, the rule in tax planning is, let's get our deductions now and let's defer our payables till later, okay? So here's a chance to get a $55,000 deduction all in this year. So this lasts until 2024. If you buy a vehicle up until 2024, you can take advantage of this program. So ask your accountant about that. If you don't have an accountant or they don't know about this, then ask us about this.
Dave, can I just jump in here? Because there's something else you told me about this when you informed me about this that I think is cool, is to know the difference between financing, paying in cash, or leasing, and the different levels of write down that you can do on a monthly basis.
Right. So typically, and that's not necessarily related to the zero emission vehicle, but you know, our philosophy as accountants is you're always better you're 99% of the time better to lease than to buy a vehicle, okay? If you lease a vehicle, you can have an $800, I think it's up to $850 monthly deduction now for that vehicle, which works out to, what's that, 8,000, 5,000, is that 13,000 a year? 850? No, it's not. I don't know what it is. Sorry, it's too late. What 850 times 12 months, what does that work out to? That's the deduction you get, right? And I just said the maximum deduction you can get if you buy a car is $30,000 spread over 5 years as a declining balance. So it's actually less as the years go along, okay? So a leased vehicle gives you a greater deduction in that year. And if you're somebody who is really driving the vehicle a lot, or even if you're not someone who's driving the vehicle a lot, you're getting a better tax bang for your dollar. So that is a, you know, with, and it's, you know, that probably is still better than a zero emission vehicle. $850 a month for 48 months is probably going to get you better than the zero emission vehicle all in 1 year. But it still is nice to have that full deduction in the 1 year. So that was probably what we talked about, Joan. I can't remember exactly. Was there something else there?
Yeah, just for clarity, like if you get a zero emission car, you're getting that $55,000 credit for the, in essence, for buying a zero emission car, right? That's an incentive to do so. But then you still get to write down the lease payments as part of your business?
No, you get one or the other.
Right. So if you're buying a zero emission car, what you need to weigh out is, are you going to, depending on the price of the car, are you going to get more value in a lease payment times 12 at 850, or are you going to get more value at the 55,000?
Yeah. So 850 times 48 is a $40,000 deduction. So even if you keep that lease vehicle for 4 years, your deduction is 40,000, but you also only paid 40,000 over 4 years. Whereas this 55,000 is all in 1 year. It looks like that is the better deal, but of course you've got to put out more money all in the beginning. Although you can, sorry, if you finance it, yeah, you get the 55,000, but you can write off the interest for the finance. That's maybe what we talked about.
You advised me to finance it, to take advantage of the 55,000, and then you write off the interest for as long as you own the car and depreciate it.
There you go. I'm glad you remember what we talked about.
I'm excited.
Good. Okay, so that's that. And I was thinking I should try to get some sort of referral fee from our local Tesla, but you didn't buy a Tesla, I don't think, Joan. You bought something that nobody else is going to have.
That's right, and it comes in October. It's the new Nissan Ariya.
Ariya. So okay, there you go. All right, everybody loves deductions, so there they are. If you folks, you know, we've had some clients who had a tough year, frankly. I have one client who owns a major restaurant at Yonge and Wellington. Essentially, you know, if you can't get any more downtown Toronto than Yonge and Wellington. And this is a restaurant that has been closed now in the last 12 months, probably 8 of the 12 months, right? And when you're paying $38,000 a month for rent, you can quickly see that, and no money coming in, it's a tough time. And we've had some clients who unfortunately have had to close businesses, and maybe, you know, maybe you've invested in something this last year and it didn't work out and you've lost your money in it. Maybe your own business, maybe a family member's business, whatever it is. You can avail yourself of an ABLE, right? A allowable business investment loss, to at least claim that on your personal taxes. So it is an opportunity, you know, sort of the silver lining, as it were, of a bad situation. Okay. You know, split incomes, you can split the CPP. That's something you should be looking to do if the spouses on your tax return this year are not in the same category. CEBA loan, this is a big one. If you have a business you can avail yourself of the CEBA loan. Deadline is the end of this month, okay? By the way, if you receive the loan, it's taxable income. At least the $10,000 that's forgivable is taxable. So if you got the loan last year, you actually have to include $10,000 in that, in your filing this year. Okay, so here is something to think about. Higher levels of personal income are taxed at higher personal rates. Lower levels are taxed at lower rates. That seems pretty obvious, doesn't it? And yet, so few of the people who first come to us as clients aren't doing anything about this. They aren't setting up a structure to be able to invest in an LP, to invest in a flip, to invest in a multifamily property, to invest in a REIT, to invest in the US, whatever it might be. They aren't setting up a structure to be able to get to a lower tax rate. They continue to get taxed at higher rates because I'm assuming everyone who's investing in your limited partnership is hoping to increase their income by doing this. They aren't hoping to make less income, right? So if you're hoping to make more income, more money, that's why we're investing. Why are you not also trying to think up a structure so that your taxes will be taxed at a lower rate? And that's really what we work on with clients who come to us at the beginning is, what is your plan? What is structure are we going to put in leave? What are we going to do about all these kinds of things that come along, right? Life happens with all these things. How are we going to make sure that we can smooth income across years, defer taxes, and make sure we keep the money in the family for you and your retirement, for your kids, for your, maybe you have a charity, whatever it might be. I'm thinking most of you don't want to give as much as you can to the government, right? Probably don't want to give as much as you can, so you got to do something to make sure that doesn't happen. All right, these are the things you can do. These are the things to take advantage of. These are how you need to, if you're building a, you know, like you know, Lori and Sherry and Joan and Liza, maybe you're building an empire. You're going to have some sort of structure. It's going to be in here. Even if you're not building an empire, you're probably hoping to build a substantial nest egg. You're going to use one of these types of things, probably multiple things in this list. All right. So as we talk about what the changes are for 2021, if you're a T4 employee, you're already seeing your CPP rate has gone up. Your federal tax rate, where we raised the actual the taxable income rate. So the highest tax bracket has gone up. So you can earn a little bit more there. The same tax rate will apply, but it doesn't kick in until a little bit higher. However, EI and CPP are both more this year. So if you aren't in the highest possible tax bracket, which kicks in at $216,000, that really doesn't help you. And you've seen your money disappear from those other two things, okay? So if you have a corporation, this is an important thing to heed as well, that your corporate tax rate will get clawed back if you have passive income mixed in with it and that passive income exceeds $50,000. This is important because there is something you can do to avoid this if you structure in time and properly, okay? There's a new American president. If you're investing in the United States, this is important. I just saw a list of his contemplated changes. One of them is raising the corporate tax rate to 28% from 21. This is a concern for people, again, use a structure that's going to lower your taxes. Maybe that's no longer the right structure for you. Maybe it is something to visit if you are investing in the States. Capital gains increases, elimination on the horizon. That's a big one, right? Because now you have to reassess your investment. Now, if your investment was buy and hold properties because you knew when you sold it, you would only pay tax on half of the gain, and that benefit is no longer there or might not be there. Now you have to revisit that investment as to whether or not it's going to return for you what you need in order to be able to retire early if you want to retire, or transition out of your job, or fund someone's education, whatever it might be. It's a reevaluation of your investment strategy and the types of investments you'll make. Okay, here are the strategy problems we see most often. Unclear goals really is the big one in here, okay? You should have some sort of plan mapped out for yourself, what you need to hit, what you're trying to achieve. You know, without that, it's hard to really put a proper structure in place for me and Jivanne when clients come to us. If you say, well, I might do fix and flip, but I might do passive. Well, holy mackerel, how are you going to do? You might do fix and flip, you might do passive. Okay, those are completely different ends of the spectrum. And by the way, or I might invest in the US, but I'm thinking of going to Nicaragua. I might be in Ireland. I'm thinking of moving to Brazil. You know, I keep what's called a magic 8-ball on my desk at work for cases like that, right? I say, what should I do? And I shake it, and you know, I come up with an answer for them, and I show them the magic 8-ball. That's go out and buy one of these, because until you get some clear goals, what you got to achieve, you know, what your time frame is, etc., it's hard for an accountant to help you. One of the things that we've started doing lately, though, is getting clients to fill out a financial planning almost syllabus, so that we can look at it and help you figure out your goals. Okay. Which I guess is the stumbling block for a lot of people, because if you're thinking about fix and flips and passive, then you've got a problem, right? They're so diametrically opposed. Reliance on disjointed advice. Oh my gosh, if you know the number of times that people come back to me and Jivanne, how many times has someone asked you something that they read on the internet after we told them what the proper treatment was? Yeah, but I just read this on the internet, right? It's almost at that point where you throw your hands up and say, well, if you read on the internet, that must be right. Let's do that then. How about we do that? Well, should we do what I decide is the right, or should we do what they say on the internet? What would you like? You know, why are you going to the accountant you're going to, or why are you going to 5 different people to try to get an answer? Okay, that's really coming up with some advice that isn't disjointed. The other things, bad assumptions, etc. So this, by the way, is a comparison of capital gains rates. What happens if it goes up to 75%? Well, there you can see your same $500,000 you just lost. Looks to me like $52,500, which is, you know, out of where are we here? Out of a $500,000 gain is more than 10% has gone to away to the taxes if there's a change in capital gains. So more than 10% less in your pocket. Okay, and that can severely impact retirement planning as well as other things. So this is the last thing I'm going to touch on here, and this is why it's so important to get with people who you can put a face to when you're investing your money. People that you know where they're going to be, you know that they have a group that's been around for a few years, you know that they've done projects before, okay? Because there are so many groups out there who are promising these kinds of things, RSP meltdowns, TFSA maximizers, things that are going to get you into trouble, in my view. I won't go into these. Maybe you've heard about a TFSA maximizer before, but every time we get asked about these things, here's my answer. And I can tell you my opinion is that they're illegal. That's my opinion. There hasn't been a court case about them yet. There hasn't been a ruling on them yet. But my opinion, having seen many strategies and schemes, is that they're illegal. So when clients bring it to me, you know, and they say, well, another accountant says it's legal, or we've talked to a lawyer who said it's legal, I say, that's fine, no problem. If your promoter is selling you a product that's TFSA maximizer, here's a very simple thing you can do to make sure that you're protected. A very simple thing. Ask them to provide the advanced tax ruling from CRA. That's it. Surely if this organization is so inscrutable, if they are so above reproach, if they have crossed every T and dotted every I and are sure that what they're selling to you or promoting for you or getting you to invest in is going to withstand any CRA challenge so that you aren't left holding, by the way, an ineligible investment in a TFSA or RSP is taxed at 100%, folks. That's called a confiscation of wealth in most countries. Your wealth will be confiscated if you invest in a product that CRA decides is ineligible for tax purposes. That, to me, sounds like, by the way, your promoter already got paid, didn't they? Because they got paid up front. So who's taking on all the risk here and telling you, yeah, an accountant said it's, or lawyer said it's okay. So ask them if they've done all these good things and they're so adept at doing these things to provide the advanced tax ruling from CRA. Surely some accountant in that entire process would have said, let's check with CRA before we do this. And you can actually get an advanced tax ruling by making a submission and getting it in writing from CRA. So far, every time I've asked the client to go back and request one of these, the answers have been, well, we don't need it. Or you know, we don't have time for that. So those are the kinds of telltale signs you want to avoid investing in these products, okay? You want to avoid anywhere where you can't do your diligence by sitting down, having a cup of coffee or a kombucha or a beer or chatting or, you know, whatever it might be with the owner, the person who's has so much at stake in this, like, you know, these folks here. So that's really the end of my presentation. Jivanne, did you want to make a couple comments about anything I saw or anything you're seeing, or I talked about anything you're seeing just before we turn it back over to Liza?
Thank you, David. The only comment I think I'll make is the increased scrutiny from CRA. That has, I think a few years ago, CRA made a concerted effort to hire more staff to go after real estate investors. And I use the word go after because they've putting them under a lot of scrutiny right now, in particular with people that are flipping and trying to say that their a house that they flipped was their principal residence. And that's an area that we're seeing more scrutiny from CRA on, and people just need to be aware of that and play within the rules and get the proper advice.
Yeah, so that to that point, flips especially right now, you know, by the way, you have GST implication if you're flipping houses, and people who say, yeah, but it's used residential. Doesn't matter. You still have to charge GST if you're in the business of flipping. Doesn't matter if it's used residential. Doesn't matter if it wasn't a substantial renovation. People are shocked when they hear this. I go to, you know, Durham REI meeting, which is a large grassroots meeting, and people who have flipped 10 or 12 houses say, what are you talking about? I don't have to charge GST. It's used residential. And I say, taxman's coming, man. He's coming, or she's coming. Yes. It's coming, because it's fairly well documented now that you are operating an adventure in the nature of trade, and you have to pay GST on your profits. So good point.
Yes. Yes.
All right. That's about it from us, Liza. I'll let you,
awesome,
I'll get rid of my screen here.
Yeah, fantastic. Yeah, I think there's lots of questions. I wrote down 10 myself.
That's too many.
Yeah, that's 10's too many. That's, yeah, you only get 5, Liza. You only get 5 questions. I think to Jivanne's point and to the point you made at the beginning, you know, first of all, why all the changes with the CRA? Like, they're going after real estate investors. Is it because there were so many kind of shady things going on in real estate, or is it because different government, or is there a reason behind that at all?
Jivanne, what's your opinion?
They weren't getting enough of the profits. But I think a lot of people are just taking advantage of the principal residence exemption. And so they brought in the rule, I think a couple of years ago, where we now have to report the sale of your principal residence in your tax return. And that I think has brought a lot of stuff to the surface. Offshore investors, you in BC, you've had the bigger problem with that. So it's a combination of people just trying to play the system. So they're pushing back now.
Yeah, one thing I'll add to that is the CRA has a tips line, and people who, you know, when I was last there in 2013, that tips line got 19,000 tips a year, somewhere in that nature. And the tips are fairly credible because they're coming from ex-spouses and business partners, et cetera, to say, by the way, do you know they sold a house, they had a house, they didn't report it. So, you know, as real estate was growing and more people were doing this, I think more and more tips were coming in, right? So CRA, you know, because frankly, you know, the same thing with the CERB, reporting on your neighbor, they're working, but they're getting CERB. That seems to be, drives a lot of what happens at CRA. Once there's a public outcry about things and people start calling in, they tend to put some attention towards it.
Yeah.
Sherry, you've unmuted. I know you've got a couple things to say.
Oh, well, I was just going to say that Sarah had made a comment about pre-sales, pre-sale condos, and we have a lot of investors that buy pre-sale condos. So it says pre-sales, if sold before completed, which would technically be an assignment, are taxable at 100% if you're holding it as an investment. Do you have a comment on that?
Sure. This is why we use a corporation, right? Because
Yeah.
you can pay 11% on that profit as opposed to your personal name. So you made 100 grand.
Right.
If you're in that top tax bracket personally, you would pay 50 grand on it. If you did in your corp, you would have paid $11,000. So there's an opportunity. Nothing wrong with doing assignments for sure, but make sure you're doing it the right way. I'm sure, Sherry, you advise your clients the same thing, right?
Yeah.
So Dave, to further that, if people have bought something in their personal name and now they're realizing that they may want to change it to their corporate name, is that possible? And is it costly? Is it painful? Because I can imagine that as people are kind of shifting and learning, they're going to be like, oh, I want to change my investment structure and get a corporation set up.
Yeah, sure. Sometimes it makes sense to change it over. It will cost money to do so. Depends what we're talking about. But, you know, if we're in Alberta, there's no land transfer tax for a property you might own there. It might be more feasible to do than in BC or Ontario. You've got to, you know, this is part of what the plan is and what the strategy is. If you're going to hold that property for 10 years, you might, and it's, you know, going to stay in the family thereafter, you might have a different view than if, you know, you're thinking of selling it in the next couple of years. So you can transfer anything you want to a corporation, but there's always costs involved. You got to pay the accountant and the lawyer, and just like all these investment things, the promoters, you know, we want our clients to make money and be protected. And so I tend to talk people out of transferring things to a corporation when it's just going to eat into their profits, right? It's better to say, okay, from this point forward, let's do things the right way, and we'll buy insurance or we'll do something for that other case.
Yeah, sometimes in BC, Dave, lawyers have suggested, and my accountant here in some instances, to, you know, when that has come up, when it's in our name and it shouldn't be, is we do a declaration of a bare trust, basically.
Yeah, and that's absolutely one of the issues, though, is a lot of the times you've already got a corporation, right? But some people don't have a corporation in place yet. So you can't do a bare trust if you don't have the corporation yet. But, right, if you've got a corp, then a bare trust is, for people listening, is a tremendously good vehicle. And so I love my bare trust story. So I'm going to tell you my bare trust story quickly. I worked at CRA, and we were trying to seize a condo from the president of Atlas Cold Storage, who was under audit. I did a lot of things, and anyway, public, it went public, everything. So I'm not telling tales out of school here, but so long story short, we tried to seize a condominium that we found in his name. And we got a call. I got a call from someone named Daniel Sandler, whom I'd never heard of, but he was a tax lawyer. And he said, you're trying to seize my client's condo. Did you check into the possibility that there's a bare trust? This is probably 2003. And I said, of course I did. Because that's what you say when you have no idea what a bare trust is, right? You say, of course I checked into it. And he said, well, you must have overlooked this. I'm going to fax it over to you. So he faxed over a one-page document, which says, I'm buying the property. It's for my daughter, essentially. All kinds of other stuff in there, but one page, signed, dated back, 1996. And we passed it around and we all laughed about it. Look what this is. He's saying he doesn't own it, but he's on title. Well, lo and behold, we sent it to Ottawa, came back, and perfectly valid way to have transferred the property or to have concealed ownership, essentially, because Sherry, your property would be registered in your name, but the beneficial owner is somewhere else. Yeah. And nobody can go after you for that property because you have a piece of paper, or you don't, and you just made one up. But whatever the case is, it's sitting somewhere. Yeah. And that's why these are so powerful and they stand up in court. Yeah. By the way, Daniel Sandler is senior partner at Ernst & Young, I've learned after, and he's defended Ford of Canada, CIBC. He hasn't lost a tax court case against CRA in about 25 years. So it's on good authority that I'm taking a bare trust and telling folks, and you got that from your accountant as well, to use them. Okay. It's good.
There was a question here about what level of total net personal income should one consider using a corporation for investments versus not?
Yeah, well, it depends. Again, what is the strategy going to be? One of our interesting book was given by one of our clients is called The $6 Million Dentist. And this was written by someone named Mark McNulty, who friend of mine, I didn't realize he was into planning for dentists, but he financial plans for dentists. And he wrote the book $6 Million Dentist because he's been doing it for about 30 years. And in his experience, fewer than 1/3 of dentists in their lifetime achieve $6 million in net assets by the time they retire. Okay. And that's instructive because so many people think of dentists as high net income earners. Indeed they are. And they think, I'd say that $6 million, every dentist probably gets there, but many don't. All right. So yet all these dentists are using corporations and using other things to be able to keep what they have, or at least as much as what they have. So your idea of what level it is that you need a corporation might be a lot higher than what I think your level is. And by the way, your level of what you think you need to get to be a high net income earner or high net worth individual, or even to that retirement level, is probably a lot lower than you think it is if we got the right plan for you. Yeah, someone asked, does the bare trust have to be recorded somewhere? A bare trust is supposed to be signed on the day of closing, but once it's signed, it sits in your dresser drawer. No one ever even knows about it, just like I didn't know about it existing until the lawyer faxed it over to me. And so I see in retrospect his question, did I check into the possibility of there being a bare trust? Well, I couldn't possibly have found out there was one anyway, right? Because it's not registered anywhere, it's not recorded anywhere.
Lori, it looks like you've unmuted. Have you got a couple of questions for Dave?
Actually, my question was about bare trust. That's exactly what we did on this flip. So we bought it in our names and then transferred it to my corporation through a bare trust. So I was going to ask you to talk more about bare trust, because that was my first time ever doing this. But I think it helped us with the financing on the front end. Yeah. So but I'm still learning the ropes on these Bear Trusts, but I thought it was quite a powerful tool to use with this flip we're doing.
Yeah, for sure it is. And it isn't confined to properties. You can go and buy cryptocurrency and trust for somebody else. You can invest in stocks and trust for somebody else or another corporation. You can do just about any asset in trust. So keep it in mind next time you want to move something around. And if you've got a corporation, say, well, I signed something. I know it is. It must be around here somewhere, Mr. Auditor. Let me just find it.
Great.
Awesome. Great. Any other questions before? I know I've still got a couple more, but we'll let other people jump in. Anybody have any other questions? I'm just going through the chat again to see if we've missed any. But feel free. This is great info, Dave. I mean, I know that what this is going to do is kind of get people really thinking about where do I get started down this path so that I start to know what I don't know that I didn't know that now I know.
Yeah.
That kind of thing, right? And yeah, it's super helpful to just be talking about some of these, you know, high level things that are really quite simple that people just aren't familiar with. We've been having a lot of conversations with people recently about family trusts, about bear trusts, about corporate entities, about buying real estate in your entity. So yeah, it's really, really good information. I can see a couple new messages down here. So let's see what they say. Yep, super helpful. Let's see, Christine, you can use a bear trust to put the pre-construction condo in your corporation. So it looks like Jivanne answered a question there. Jivanne, do you want to dive in a little deeper on that one, or was that pretty straightforward?
Oh, I think that's pretty straightforward, as David explained. There, you're purchasing it in your own name, but you're holding it in trust for your corporation. So, and somebody I think pointed out that it's easier to get a mortgage in your personal name as opposed to a corporation. So this is where a bear trust could also be very handy.
Yeah.
So, I
what
know.
Happens? Oh, sorry.
Go ahead.
No, you finish.
No,
It's
what I
just
was
another
going to
question.
say, I know when my husband and I got started in real estate, that's what we did, because it was certainly, our corporations were new. And so we qualified for the mortgages personally and bear trusted the properties into the corporation on David's advice, by the way.
Makes sense. Yes, on David's advice. There we go.
Yeah.
Sherry, you wanted to add something to that?
Well, no, I was just saying there was a question about what happens when you sell the asset that's held by Bear Trust. It's taxed in the beneficial owner, right?
It's taxed in the corporation, yes.
Yeah.
Yeah, Bear Trust is B-A-R-E. It means nothing's in it. There's nothing here. The only thing that's here is my obligation to do something when you tell me to do something, okay? Everything else is with the beneficial owner, but this trust is just me here, and I'm waiting for instructions from you. Sell it, okay, I'll sell it for you, or buy it, or whatever it might be, refinance. That's the Bear Trust part.
Dave, I have another question here for you. So I have 3 rental properties in Alberta. They're in our personal names, and I mean, the Alberta market's not doing so well and our properties are not doing well. Would you advise to put those into our corporation at this stage of the game? There's that.
I mean, in the context of your large planning, so we don't want things in your personal name, 3 properties and adding more. We wouldn't want it in your personal name. Here would be an opportunity, if they have gone down in value, potentially to transfer to them corp at fair market value and report a capital loss on your personal tax return that you could use against other gains, right? That might be something to think about. You wouldn't even have to use a Bear Trust. You just transfer it at fair market value for a loss. You'd need to get the bank on board with a corporate mortgage at this point. But maybe the bank would be open to you making the transfer and then taking the mortgage in trust for the corp. So certainly something to think about. But you know, the bottom line I want people to remember is that if you're building anything, you need to do it in something other than your personal name. Unless you're building things that you know are going to be losses, you know, if you knew these were being losses, you wouldn't have bought them. So, right, in the first place. But if we're building something that's going to go up in value, there's no way we're going to be able to transfer that to anybody in the future if we want to give it to somebody, if it's in our personal name, without there being taxes to pay. But in our corporation or in a family trust, we can pass these things along. Moreover, we can get way more deductions in a corporation than we can in our personal name. Lastly, not lastly, many more things. But one other thing that is a big thing is that in a corporation, we can actually defer the capital gain on the sale of a property. Okay? People are saying, no, you can't defer a gain. We can defer the gain on a sale of one property if we have other properties by taking losses by using CCA. This is getting a little complicated now, but suffice to say, in your personal name, you cannot take a loss on CCA, which is capital cost allowance depreciation. You can go to zero, that's it. In a corporation, in the business of real estate, we can take losses using CCA. Why is that important? I charged all these properties down and now I sold one. I might have that depreciation back on that one, but I still have all these losses. I can defer that capital gain. Nobody probably followed me there, but follow the gist of it. Use a corporation, okay? There's things open to you in a corp that aren't available in your personal name. That's why we like them. That's why I don't have the slide open here, but that's why we had Minister Bill Morneau on the cover of the Huffington Post, and they were talking about corporations are costing Canadians $10 billion a year. Well, those types of things are what you can do, Lori. Okay.
Okay. So if I had issues with the banks about the transferring of the mortgage into the corp, then the other alternative is just through the Bear Trust.
It is, yeah.
Yeah.
Look, all you folks who are running this business now, because that's what you have to think about it. Whether you're Crown Capital building big buildings, or whether you're an investor investing in projects, you have to think of this from a business point of view. And you're going to have your team. Your team's going to include a good realtor, good lawyer, good accountant, good mortgage broker, right? And you're going to get some guidance from your mortgage broker, and you're going to talk off the record a little bit about these things. Not on the record, off the record, right? And you make sure it's off the record so that they don't have to disclose anything, doing the same thing with the lawyer and the accountant. And you figure out a way, because there's going to be challenges. You want to build a duplex, you want to build a 500 unit building, whatever you want to build, it doesn't matter how many you've done, something's going to come along that's just going to be like, oh my gosh, what am I supposed to do? That's why the team is so important. Okay.
Absolutely.
Yes, and thank you for pointing out that whole business about the team and about getting things done first, right? So many people, myself included, jumped out of the plane and put the parachute on the way down. So, you know, it's better to get things done in advance. And so for those of you who maybe haven't started doing anything yet, you know, just starting, as David mentioned, start with the plan. Like, where do you see yourselves in the future? And Dave, I love the fact that you mentioned that so many people think they need so much more to retire. And when you actually sit down and do a budget and sort of like, you know, one of the things we do with our WREN members is we do a realistic budget and we do a dream budget. So if you were like doing all the things you wanted to do in retirement, how much would that cost you? And most people are spending, like, doing all the things they want to do. They're not even spending $10,000 a month. And they think that they need to have millions of dollars. And it's like, well, you've listed all the things you want to do. You want to travel, you want to spend more time with your mom. You know, you're not that fussed about having more stuff. People don't need as much as they think they do. So when they do the planning now, to figure out what they need, and then you take that stress off, and then you can do the right planning, make the right decisions, and you don't need to work as hard as you thought you might. So that was a big lesson for me. And I know that when we do those budgets with people, they're often really surprised. They're like, oh, I thought I needed way more money to retire, and I don't need that much.
Well, look, and you know, we get a lot of people who've jumped out of an airplane without a parachute, and about the only thing we can say is, don't worry, it'll all be over soon, right? You know, and so one of the questions was about a personal residence in your corporation. So this is an occasion where you likely aren't going to do that. Okay, there are very few freebies in Canada. One of them is selling a principal residence, at least right now, without having to pay capital gains taxes on it. If you put it in a corporation, we do have some people will put it in a corporation. Maybe you are at extreme risk of getting sued for some reason. You're a lawyer or you're some other high risk profession, you might use a corp. But otherwise, don't put your principal residence in a corp. Don't put a property, a rental property in a corp that you think you're going to move into in a couple of years. All right, because now you're going to lose your opportunity to get tax-free gains on that property.
Is that going to change, Dave? A lot of people have been talking about that.
I mean, if it could. It's in the United States, it doesn't, I mean, you pay tax on your principal residence, so up to an exemption level. So it could. I think the capital gains tax increase would come before that. There'd be such an outcry. You know, so many people are using their house for retirement that I don't know, you know, our government is so intent on popularity, doing the popular thing. I don't know if that's popular. So,
There
but
would
look,
be a rebellion for sure.
Yeah. Should you add your kids to a corp? You might want to. So there's a difference between using a corporation and a family trust. If you add your children to a corp and they get married and they get divorced, that divorced spouse, that's their half of the shares in your corporation. That's a big risk. If you instead create a family trust and give your children a beneficial interest in the family trust, which owns the corporation, now any divorcee can't get access to anything your children might have in that trust. So you might want to choose something different depending on what we're talking about. That's all part of the planning.
Great. Very cool. So we've, yeah, Joan's got a question. We're at 8:15. We'll probably go for just a couple more minutes. We usually go between 8 and 8:30. And of course, Dave and Jivanne are in Toronto, so it's not midnight yet, but it's probably past your bedtime. Dave says he feels all energized when he does these events, so you might not be sleeping for a while. You'll be like, I'm going to go do some tax work.
Going to run a marathon.
Great information. Joan, you've got a question for Dave?
Yeah, she put in here, is it still 1 year for it to be considered your principal residence? In other words, you have to live in it for a year?
It's never been a year. Okay. So this is a misconception. If
there you go.
You know, if I live in a property for a year and I sell it, well, then I get to claim a capital gains exemption. In fact, we're seeing CRA now cracking down on the person who bought a property, lived in it for a year, moved, lived in another property for a year, moved, lived in another property for 2 years, moved. This, right, it is a question of fact whether or not your intention is one of capital or your intention is one of making money. It's a very difficult thing for CRA to determine, really, if we're thinking objectively of this, but they're not thinking objectively, they're thinking subjectively. So, you know, there is the occurrences now of CRA saying, I don't care that you lived there for 2 years, we are charging you income as business income, the disposition of that property, because you've done it 3 times before. And this isn't just somebody moving for the sake of coming to a new house, you're doing it to make money. So it's a very tricky thing. The one area where it is 1 year, however, is your GST rebate. Maybe you bought a pre-build and you moved into it. You've got to live there for a year before you sell it or rent it out, or else you got to pay that GST rebate back that you got when you close the property. Okay, that's the only one where it's 1 year. But the principal residence, it should be okay at a year. You should be, you know, it should stand up. But if you do it continually, CRA will say there's a pattern here. You aren't using it as capital, you're using it as income. Okay. Okay.
Rosie's got to do
in stocks and corporations. Should I cash them and buy real estate? No. I laugh at that. I don't know, because I'm asking myself that same thing, right? I don't know where to put my money. I made some money in Bitcoin. Okay, should I take it out? Should I keep it in? What's going to happen? I don't know. So look, you should, one, we all got to sleep at night, right, folks? So there's the first thing. You've got to have your money working for you in such a way that it's going to achieve your goal. Okay. So,
Yep.
right, if it's in a place where it's on track to get there and the returns are going to be there, that's all that matters. And if it's in a place right now where, you know, it's not going to be getting you there, well, then you got to repurpose it. You got to move it elsewhere for sure. Okay. And if it's in a place where you're having trouble sleeping at night, well, that's probably a sign you got to move too. Okay.
Yeah, when I was a financial planner, my answer to questions like that was always depends. It really depends on your own situation and your own goals, right?
Did you I mean, did you have a crystal ball handy for anybody, or?
Yeah, no, we wish, hey, wow.
And I guess, you know, diversifying, right? I mean, if you've got everything in the stock market, that might be, some people might think that's a little risky, or if you have everything in real estate, some people might think that's a little risky. So
There's another question there, Dave, about income.
Yeah. I keep being advised that I should not incorporate. Okay. But you just got advised that you should incorporate. So you're not keeping getting advised. That just changed. Just told you should incorporate. Okay, you got 6 properties you should have incorporated on your first property, because now you know that the best time to plant a tree was 8 years ago, right? Second best time is today. So where are you going from today onward? It's too late probably to move 6 properties into a corp now. It costs a lot of money to do that. Especially if they've gone up in value, and especially if they're in BC. But going forward, I mean, if you're on here, you're taking this seriously, it's time to get some better advice, because someone hasn't helped you out, in my view.
great.
We got our Bear Trust notarized. Is that actually necessary? Notarized isn't necessary, witnessed is necessary. But in fact, that's not even necessary. We had a court case, CRA, where someone bought 22 townhomes and said they got into big trouble, went bankrupt, and people tried to collect from him, including CRA. And he said, they were all in trust for my mother. The mother had never even signed the Bear Trust agreement, but the judge at court said, I have no doubt that the mother meant to sign it. She simply forgot to do so. So,
Wow.
and there you go.
Wow.
Yeah. Dave, what are the CRA's rulings with digital signatures nowadays?
Oh, good question. I'm not sure. See, I got stumped there. It's bound to happen. Jivanne, do you know, are they accepting digital Oh, aren't they accepting T183 digitals?
Yes, they are.
Oh,
Yes.
okay. So that's good.
Oh,
Yeah.
there you go.
That's probably just because of COVID, right? Probably when it
Yes.
happened. Yeah.
Yes. Yeah, but the T183, there's of course, a series of questions to answer about the digital signature, but they're still accepting it. So
Good.
And my friend Robert has he's got a good question. He's looking for a financial planner or advisor, and he Robert, I'm not going to share your full story, but let's just say he's talked to a couple of people, and because he's a curious person and he really wants to learn, there are a couple of people who just don't want to have him as a client because they don't want to answer his questions. It's like, okay, well, I wouldn't be going with that person, you know? So, yeah, so he's looking for a good planner or advisor. And I did suggest to him that, you know, a good place to start is doing a little bit of a budget and some goal setting, and getting some tax advice, because I know he's got a business as well. And so, yeah, so I think some tax strategies would probably be super helpful for him.
Right. Yeah. Look, we aren't certified financial planners, and that's not what we do. We're accountants. but we are business advisors and we are investment advisors in the sense of helping you achieve the most money in your pocket after tax. But you've got to come to us with some sort of plan, like I talked at the beginning, right?
Yeah.
So if it's a matter of, and we're trying to help a little bit with the clients who haven't had financial planning, you know, laying out all the assets, laying out all the liabilities, laying out what you got to get to. We're trying to help a little bit with that, but that's still the purview of a financial planner. But you're more than welcome, Rob, to reach out to our admin, Melanie, and book a time to chat with me, and maybe there's a good fit for part of that with us.
Yeah, I also sent you a name. You had posted something on Facebook and Fearless Investors, I think it was, or something.
It was in the WREN Club, Sherry.
Or the WREN Club, sorry. Yeah, so I did put a name there. You should call her.
Okay. Oh, excellent. Thank you.
Yeah.
I love this question. Buying 2.5 acres, used partially rental vacation. Can we open a family trust with our children? I mean, these are the occasions when you do open something up, especially we have a client who bought a cottage in Grand Bend, Ontario, wonderful vacation spot in they've had it for 52 years, 52 years. You can imagine in the hottest vacation spot in Ontario, and they're fairly elderly now, they want this cottage to go to their grandkids. The amount of tax that they have to pay on that is phenomenal. You know, we're talking like a, you know, a $500,000 tax hit to give this to their grandkids, whereas simply setting up a family trust for the grandkids now with nobody paying any tax, right? So if your plan is to buy something for your family and keep it in the family trust is a terrific vehicle for that. Or family trust taxed at a higher rate. So family trust can be a flow through. So whatever if you want the money to come out of the family trust to you, it's just taxed in your name, in your own taxes, and the trust pays nothing. If you keep it in the trust and grow it in the trust, then it's taxed at the highest marginal rate, 50.4%.
But you can flow it out to your children.
You can flow it out with no tax, yeah. And a trust tax return is cheap. I think we charge $600 for a T3 return. So it's not even that expensive. Not like corporation returns a lot more than that, right?
Mm-hmm.
So good question. I love family trusts because they achieve so many great things.
Seems like it's a hot topic now. There's lots of questions coming in.
If you give your children money, are they taxed on this? Not in Canada. You can give people anything you want, but if you give your children money and they invest it and they're under 18, then attribution rules kick in and the money gets taxed in your name. Yeah. Okay. So that's one of the things in the US, by the way. You can't give money even to your spouse without somebody paying tax on it, right? The exemption limit, I think it's $10,000. Wow, that's incredible. But in Canada, nothing. Can we set up a family trust after owning the property for 5 years? Absolutely, you can do it at any point in time, but again, doing it later usually costs more money and has tax implications.
Mm-hmm.
So doing it on purchase is the smartest, or doing it that taxation year?
Yeah, doing it at the beginning when there's no accrued gain is probably the best.
Do it when your accountant tells you it's the best time to do it.
Plant that tree.
You know, your accountant is a vital member of your team, right? And what's the benefit of having someone on your team if you're not going to listen to them or take their advice, right? So you need to find.
Sherry, I need you on all my webinars, please.
Yeah.
You know, as I tell people, you know, we advise clients on what to do, but clients don't always follow our advice.
I know. No, they'd rather go on social media and ask a bunch of strangers.
Yeah, or
that's
do
what
something
I find
else.
Phenomenal.
Yeah,
is that they don't go to their team members. They go to social media platform and place a question out there to 200 people that they don't even know. It baffles me, as opposed to taking a trusted advisor and go with them and take their advice. right?
Baffles both of us.
Yeah, yeah.
And that's why we do these, so that we can share the information with everyone so that they can fix the errors they've made, find a new accountant,
Yeah, exactly.
for what's coming, and yeah, just start to be on the right track. So it's 8:28, so we'll get this wrapped up. It's late for David
Yeah.
and Jivanne.
Thanks, guys.
So awesome information, both of you. So many great answers, so many great questions, and I know that you know, I'll be checking in with you at some point over the next few days, because I need to find out about buying my mobile home under my business, because I'm going to be putting it up on my soup property. And I need to find out if I can buy a demo as the zero emissions vehicle. So I got a few more things to figure out what I can, what I need to buy and what I can save. So we'll talk about that stuff, and then we'll talk about the soup property as well. And we'll tell everybody about that on the next call as well. But lots of great information. Thank you both for staying up late with us. Jivanne, it's been a joy to meet you virtually.
Thank
Can't
you.
wait to be working with you more. And David, as usual, it's awesome to connect. We always try to send you lots of energy, and it sounds like you're always enjoying it. So great to have you back on camera and
Yeah.
giving great information.
Thanks, Dave. Really
Yeah.
Thanks,
fantastic.
guys.
Thank
Thanks,
you.
folks. Have a
Thanks,
great night.
everybody.
Have a good night.